The worst thing you can do as an investor is blindly follow the masses because sometimes the M is silent. What's up everybody, I am Jaspreet Singh and welcome to the Minority Mindset. Investing is one big game. Like roulette? Come on black! No. Roulette is gambling. You have no control, it's all luck. You're throwing your money on black and hoping the ball doesn't land on red. No, double zero! Investing is more strategic, it's kind of like billiards. The more you practice, the better you're gonna get. But no matter how good you get and how well you align your shot, every once in a while, your brother is gonna accidentally trip onto the table and stop your ball from going in.
My bad.
We saw it happen with the 2020 Black Swan pandemic. No one can predict that type of stuff. But to help you make smart shots as an investor, I'm going to go over 5 things that you can do to be a better investor than others. So make sure you watch this video until the end. But before we get into that, hit that thumbs up button below and subscribe to the Minority Mindset YouTube channel. That way you don't miss our new financial education videos every single week. And hit that little notification bell too, because if you don't, then YouTube doesn't let you know when our new videos are released. First, don't blindly follow the masses because sometimes the M is silent. A good rule of thumb is to listen to the mass media about investing and then do the opposite. When they say markets are doing great and nothing can slow down the economy and this bull market can never end, that might be a good time to start selling. When they say the world is ending and the economy is going to collapse, that might be a good time to start buying. By the time the news reports that a company is doing great and is breaking records, you're too late for that rally. But as soon as the media says that, that's when FOMO kicks in, and that's when the majority of people start buying. FOMO is a small acronym that stands for the fear of missing out. And that small acronym makes investors make some big mistakes. Your neighbor tells you about how they made a killing buying some extra houses, and then you hear the news talking about how real estate can't be stopped, so you get excited. Oh my god, I want it! Real estate 2008. Or you hear your Uber driver talk about how they made all this money off of this new thing called Bitcoin, and then you listen to the news, and the news says that Bitcoin is going to the moon, and so you want a piece of it. This is my chance to get rich! Bitcoin crash 2017. Or you hear somebody on Instagram talking about how they got rich in the stock market buying Tesla, and then you look on the news and they report that this bull market cannot be stopped, and so now this is it. You want a piece. Yes, this is my chance. Corona 2020. The news gets you excited, so you want to come in and buy, and then you blink. And then reality hits, and then all of a sudden, your investment gets sliced in half. Where'd all my money go? Don't blindly follow the masses. If the media is reporting on it, you missed that rally. You need to be planning 2 steps ahead. What happens after the media reports on something is called euphoria, because after a financial rally, emotions kick in and that drives investment prices way higher or lower depending on what's happening in the market. And that brings me to number 2. Don't let your emotions block your profits. FOMO is an emotional reason to invest, and nothing kills more profits than emotions. We've seen it happen time and time again. I do a lot of real estate investing, and a big difference between real estate investing and stock market investing that a lot of people don't talk about is the human aspect. If you invest in McDonald's or Apple or Amazon, you're not the one dealing with customers. You're buying a company that does that. If people don't have the money to buy an iPhone, you're not the one telling them no. Apple employees are the ones doing that. With real estate, it's a little bit different. Sometimes people struggle and they run into financial problems, and that's where you, as a real estate investor, have to make the decision. Are you gonna let them stay for free, or are you gonna kick them out? Running a real estate investment business is expensive. You have loan payments to make, taxes, insurance, maintenance, management fees. So even if you're not getting paid, you still have expenses to make, but you feel bad. So what do? Well, there's a difference between doing charity and running a business. Charity is great, but you can't do any charity unless your business makes you money. I'll be honest, this is something that I have struggled with. But there's a balance between being understanding and running a charity. Like when the whole pandemic happened earlier this year, we gave a helping hand to some of our tenants who were struggling financially. But you cannot, listen to me, you cannot build a successful business by running it like a charity. Remember why you started investing in the first place. It's to make a profit. Third, never stop learning. When an interviewer asked Warren Buffett what was his secret to success and his secret to becoming one of the wealthiest and most successful investors in the history of time, he just pointed at a stack of books and he said, never stop learning. I read 500 pages a day, and that learning fuels my success. Ray Dalio, the billionaire founder of Bridgewater, the hedge fund that has made more money for their clients than pretty much any other hedge fund out there, said in his book Principles that his secret to success was learning, because he spent most of his time learning about historical events in the stock market, and that has fueled his success because he could predict what was going to happen based on historical events. So what does that mean for you? Read books, buy courses, and make a whole lot of mistakes. That way you can learn from them. What you'll find is that the more you know, the more you'll realize you don't know. And if you're looking for where to start, we have a free ebook on money management and investing that you can read for free when you sign up for our financial education emails. And you can do that by clicking on this link right here, or by clicking the link in the description below. Fourth, apply your knowledge. In August of 2019, Roku was trading at like $120 a share, and that's when the news came out and they said that Roku was growing faster than Netflix was at the same point. Well, that news naturally got people really excited, because if Roku's the next big thing, that means it's going to be the next Netflix, and you want to get in soon. So that news drove up the Roku stock from $120 a share in August to $169 a share in September, just a few weeks later. That's a 35% jump. And then by the end of the month, reality hit, and the stock went from trading at $169 a share all the way down to below $100 a share within the same month. That's a 41% drop in market value. How can a company lose almost half of its worth in less than a month when nothing bad happened? Oh yeah, emotions. What people weren't analyzing was that Roku and Netflix are completely different businesses with different business models. Netflix is a paid content subscription business. Roku isn't. Roku is free, so obviously it should be growing faster, and it isn't even in the content creation game like Netflix. Roku is there so people can watch Netflix easier. You have to compare apples to apples, which is why learning is so important. This way, you can make your investment decisions financially instead of just emotionally. And number 5, maybe the most important thing you need to have is patience. Warren Buffett says that the stock market is a device that transfers money from the impatient to the patient. I think that applies to all investments. If you're looking for the hot stock that's gonna make you rich quick, you're going to be the person making patient investors very wealthy. Stock market people, companies take time to develop, and real estate people, cities take time to build. The big money isn't made overnight. It's made through slow, long-term sustainable growth where you are compounding your money over a number of years. Ain't nobody got that kind of time to get rich. Plus, if you're impatient, you'll be more likely to panic sell when things go wrong, instead of using a downturn as an opportunity to buy great stocks at a big discount. Remember, you're in this for the long term to build wealth, not to make a quick buck. And if you want to learn more, remember we have our free ebook in the description below, and we have a ton of other videos that you can watch. Thank you for watching. If you enjoyed this video, share it with one friend. That way we can help spread the word. If you want to learn more about mistakes you should not be making as a stock market investor, I already made a video on this, and you can watch it on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.